Over 60% of Bitcoin hasn't moved in over a year. That's right. While CNBC declared it dead for the 487th time, millions of holders didn't sell a single Satoshi. Why? Because the game has changed. Soon, Bitcoin holders won't ever need to sell again. And here's the kicker. 13 of the top 25 US banks are already building the infrastructure that makes this possible. If you click this video, smart move, because once you see what's happening, you'll realize selling Bitcoin may go down as the single dumbest financial decision of this decade. This isn't financial advice, it's for education and entertainment only. Think of me as your sarcastic tour guide through the wild world of money. We've all heard the advice that buy low, sell high. Sounds like common sense, right? Except here's the problem. Bitcoin doesn't play by traditional rules. When you sell, you don't just take profit, you amputate your future upside. Imagine being an early Amazon investor in 2002, doubling your money, selling, and then watching it 300 times. Congratulations, you just bought yourself an expensive lesson in impatience. And with Bitcoin, the penalty for selling is even worse. Not only do you lose future gains, but Uncle Sam shows up waving his hand for taxes. Short-term gains? You're paying income tax. Long-term? You're still paying capital gains. Selling isn't just losing money, it's volunteering for a tax audit. The trap of buy low, sell high is a gambler's mentality. It assumes you can time the market perfectly. Spoiler, you can't. Nobody can. Even the so-called experts on Wall Street barely beat coin flips. So if selling locks you into taxes and regret, what's the smarter play? Well, it's the same move the ultra-wealthy have been using for decades to dodge taxes and build generational wealth. Enter Bitcoin-backed loans. This is where things get spicy. Instead of selling your Bitcoin to get cash, you borrow against it. Your Bitcoin sits as collateral, safe and appreciating, while you unlock dollars for spending, investing, or just covering life's expenses. It's like refinancing your house without ever moving out. You don't lose the asset, you just unlock liquidity. Think of your Bitcoin as a rental property. Do landlords sell their apartment building every time they need money? No, they take out loans against it. The property keeps appreciating, tenants keep paying rent, and the landlord uses leverage to expand. Bitcoin holders are about to play the same game, and banks are preparing the chessboard right now. Major institutions like Fidelity, BNY Mellon, and BlackRock aren't just interested in custody, they're setting up systems where Bitcoin acts like pristine collateral, just like US treasuries or gold. But how does this look in the real world for someone like you? Let's run the numbers. Imagine you own one Bitcoin worth $120,000. A bank offers you a loan at 3% interest with your Bitcoin as collateral. You borrow $50,000. Now, instead of selling your Bitcoin and kissing future upside goodbye, you've got cash in hand while still holding the asset. You might use that loan to buy a rental property that cash flows every month, start a small business, or just build a diversified portfolio that makes more than 3% interest. Fast forward 2 years, Bitcoin rips to $200,000. Your single Bitcoin is now worth more than your entire loan. You either pay it off with pocket change or roll into another loan at better terms. It's the financial equivalent of eating your cake and having it too. You didn't sell, you didn't trigger taxes, and your net worth grew on both sides, your Bitcoin and the assets you bought with the borrowed cash. Sounds like a cheat code, right? That's because it is. And it's the exact cheat code billionaires have been running for decades. Here's the part nobody tells you. Billionaires don't sell. Ever. Jeff Bezos doesn't dump Amazon stock to buy another mansion. Elon Musk didn't sell Tesla shares to buy Twitter, he borrowed against them. Real estate moguls don't sell skyscrapers, they leverage them. Why? Because selling creates taxes and shrinks your empire. Borrowing creates liquidity while the empire keeps growing. Now, Bitcoin is stepping into that billionaire blueprint. It's liquid, it's scarce, it's global. And for banks, it's pristine collateral. The same rules the ultra-wealthy have always played by are about to apply to average Bitcoin holders. But here's where things get wild, because when you stop selling, it doesn't just change your finances. It changes the entire Bitcoin market. Every time someone takes a loan against Bitcoin instead of selling, That coin effectively leaves circulation. It's locked up as collateral. Multiply that by millions of holders and suddenly the supply on exchanges shrinks. What happens when supply drops while demand rises? Prices explode. This isn't just theory, it's already happening. Long-term holders, people who haven't moved Bitcoin in over a year, now control nearly 70% of supply. And institutions are lining up to grab what's left. On top of that, there's the speculative attack loop. Borrow cheap dollars against Bitcoin, buy more Bitcoin. Lock it up, rinse, and repeat. While fiat loses value from inflation, your Bitcoin snowballs in purchasing power. But don't think for a second this revolution is happening without the banks. In fact, they're already elbowing their way in. By the way, if this is flipping how you think about Bitcoin, drop a quick hello in the comments. Always curious which part hits hardest for you. Banks aren't suddenly pro-Bitcoin because they get it. They're pro-profit. And Bitcoin is the juiciest opportunity they've seen in decades. They've watched exchanges like Coinbase make billions in fees while they've been stuck on the sidelines. Not anymore. JP Morgan, Goldman Sachs, Fidelity, they all want a piece of the Bitcoin loan market. And here's the kicker. To run that system, they need one thing: Bitcoin collateral. That means banks themselves will start hoarding coins, directly competing with retail buyers. When Chase and Citi are scrambling for Bitcoin the same way they scramble for treasury bonds, you'll see prices move like never before. And here's a history lesson. When institutions start buying an asset, they never stop. Look at MicroStrategy. Did they just buy a little Bitcoin and call it a day? No, they issued corporate bonds, borrowed billions, and turned their balance sheet into a Bitcoin vault. Or look at university endowments, Harvard, Yale, Stanford. They started small, but once an institution allocates, they don't sell. They accumulate because their job is to think in decades, not days. And soon, pension funds, insurance companies, and sovereign wealth funds will join the parade. Once they get exposure, the idea of selling disappears. Bitcoin becomes a permanent allocation like gold, but with a growth curve on steroids. So what does this all look like in the future? Let's jump forward and peek at the world we're heading into. Picture this. It's 2028. Your neighbor walks into Chase Bank with 0.1 BTC. He walks out with a $10,000 loan at 3% interest. He buys a rental property with it, collects rent, pays the loan interest, and his Bitcoin still doubles in value. At that point, why would he or anyone sell? It'd be financial malpractice. Instead, Bitcoin becomes the collateral foundation of the financial system. Just like you don't sell your house to buy groceries, you don't sell Bitcoin. You leverage it. That's when Bitcoin shifts from being magic internet money to the backbone of a new financial system. But before you get too comfortable, there's one harsh reality you need to know. Not everyone will get a full Bitcoin. Institutions have already hoarded over 1 million Bitcoin since 2020. That's 1 million fewer for retail investors. And with only 21 million coins ever, most already mined, the window is closing fast. The average American won't ever own a whole Bitcoin. Soon, even 0.1 Bitcoin will feel like beachfront property in Manhattan. Out of reach for most, a trophy for the few. And as more coins get locked up as collateral, liquidity tightens. Scarcity isn't just a buzzword, it's the core driver of Bitcoin's value. So if selling is a trap and scarcity is closing in, what's the move for everyday investors? The new playbook is simple but powerful. Accumulate and collateralize. Stack sats however you can. Side hustle money, investment profits, whatever. Don't sell. Instead, when life throws expenses at you or opportunities appear, borrow against your stack. Do it responsibly. Don't go full degen and over-leverage. But used wisely, this strategy lets you live, invest, and grow wealth without ever sacrificing your core Bitcoin position. This is how you ride the greatest wealth transfer of our lifetime. Not by selling into short-term gains, but by holding and using Bitcoin as the financial engine it was designed to be. So let's tie this up. The old model, buy low, sell high, belongs in the history books. The new model is buy, hold, collateralize. That's why over 60% of Bitcoin hasn't moved in a year. That's why banks are scrambling to build Bitcoin loan platforms. That's why Institutions, once they buy, never sell. And that's why the smartest Bitcoin holders will never need to sell again. They'll borrow, they'll leverage, they'll live off the system while their Bitcoin quietly compounds for decades. Hit subscribe if you want to stack knowledge as fast as you stack sats. And remember, the future doesn't belong to the sellers. It belongs to the holders who never let go.